Hello everybody, welcome to another one of my investing videos, and my name is Mark, and in this video I'm going to show you some real live option trading that I did. The market is closed now, so it is not 100% perfectly live, but it is close enough. I did this several hours ago on Twitter. I bought a call option on Twitter, and I have been slowly making money using my call as leverage. So let me show you what I did. So let's first go to my transactions and let's scroll down, and here's what I've been doing so far. So as you can see, on September the 10th 2018, today is September the 24th, so 2 weeks ago I bought one call option. It's a $30 call on Twitter, and it expires in January of 2020. That is 16 months from now. This is September of 2018, and I spent $777.71. So you can see that it does not take, you do not need a lot of money to be buying and selling options. You don't need very much at all. So that's what I did on September the 10th, and then I immediately sold a $30.50 call option, which expires 4 days later on the 14th of September, and that day has come and gone, and I did a video on that, and I got in $50.29, and I bought it back for $3, so I made a nice $47 profit, and then I immediately sold another one, and I took in $48.29. And this one, look at this. Okay, today is September the 24th, and you can see September the 24th, removal of option due to expiration. So let's see what that is all about here. So here we have the call. It says right there it's a call, and the strike is $30.50, and expiration September 21st 2018. Right, and so that's this call right here, right? $30.50, $56, expiration September 21st. So I sold the open, and I did that on the 14th, and then on the 21st it expired and it went to zero. Didn't even buy it back. So I made the full profit on that option and made $48.29. So how am I doing so far? I've made 50.29 minus 301 is 47.28 plus 48.25. I'm sorry, $48.29. That's $96.68. So let's just say, to make the math easy, I made $96 in all of 2 weeks on my $777 investment. And then this is what I did today. Today I sold another call, and this time I chose a lower strike price, which I will explain in a minute. Okay, I sold a $29 call, and this one expires on September the 28th 2018. That is 4 days from now, and I took in $28.29. So what is going on here, and why am I selling all these calls? Well, first of all, let me go back to my account and show you what I got. Okay, this is my money here. Okay, it's my margin account. I have $2,365.79. Okay, I used part of that money to buy this one call option right here. Right, one lowly call option that I spent $777. Right, so I have a whole year for Twitter to go up. Now, if you know anything about break-even prices, the break-even price is the price that Twitter needs to go up in order for me to break even on the call option that I spent. Okay, when you're buying stock, there is no break-even price. There is a dollar cost average, but there is no break-even price because stocks don't expire. Okay, and that's one of the advantages of call options, is that you can actually break even and even make money on the contract itself. You don't have to ever use your call option to buy the shares. You can just buy low and sell high on calls. You can do the same thing with puts, right? And so the break-even price is how much money does Twitter need to go up in order for me to break even. Okay, and the answer to this is very simple. Okay, I spent $777 on a $30 call. So if you add the two together, 30 plus 77 and 71 cents, then Twitter needs to go up $7.77, and that's my break-even price. So if I pull up Twitter here, and actually I'm going to go to TradingView. Okay, this is TradingView. It's a great website here, and let me pull out a longer chart so it shows higher prices. So Twitter needs to go, let me put a little arrow here, needs to go right about there. Let me turn this puppy around like that, and then do that. Okay, that's where Twitter needs to go right now. Twitter, let me make another little arrow. Right now Twitter is, let me pull it, oops, did it again. Let me pull it out. Twitter is like down there. That is a very ugly arrow, but right now Twitter is down there. So Twitter needs to go up to $37, right? Way up there, right? And that's a long ways to go, right? So that's the reason, going back to my Ameritrade here, that's the reason why I am selling to open. I am selling calls on a weekly basis, because if I sit around and wait for Twitter to go up to $37.70, it might do that, but it might not. And if it doesn't, if it only goes up to, let's say, $36, then I'm going to lose $170, right? If it only goes to $30, then I'm going to lose this entire money, right? So I don't want to do that, right? So one of the things that I do is I sell call options, because every time I sell a call, I am compensated for that transaction. And the reason I'm compensated is because there's somebody out there that is buying this call option from me because they believe that Twitter is going to go above $30.50 in the next, let's see, 4 days, right? From the 10th to the 14th. And so they're giving me $58, right? And so basically somebody is saying, I'll give you $58 for the right to buy Twitter at $30.50 a share from you. And so I say, okay, and so I get $50.29 for that risk. Right now, if Twitter goes up to let's say $32, then that option buyer out there makes a profit, right? He's able to buy shares for $30.50, then turn around and sell it for $32, and he makes $150 on a $58 investment, right? That's great return on his money, right? But me, right, I'm saying no, I don't think it's going to go that high, but if it does, if you've been watching my videos, then all I have to do is buy this one back, get out of this contract, and then I can sell to open a new contract. The strategy is called rolling up, and you can watch my other videos, learn how to do that. I might do a whole video on how to roll up and roll down calls and puts, since I think that is one of the fundamental skills that you need to have if you're going to be buying and selling options. Okay, now if I wanted to, I could have just bought this $30 call for $777 and sit around for the next 16 months hoping that Twitter goes up to $38 or $39 or $40 or whatever, right? But since I don't know if it's going to go up that high, then I choose to sell weekly calls. And the reason I sell weekly calls is because look at how much money I could possibly make. Let's say Twitter just flounders at $30 for the next 16 months. Here's how much money I will make. If I'm making $50 a week, okay, a month is like 4 weeks. A month is actually 30 days, but let's just say it's 4 weeks. 4 weeks is 28 days, and let's say a month is only 4 weeks, okay? So my call option here expires in January 2020. That is 16 months. So what is 16 times 4? Well, 10 times 4 is 40. 6 times 4 is 24. So 40 plus 24 is 64. So if I make $50 a week, 64 weeks, I mean, do the freaking math. That is over $3,000 that I'm going to make on a $777.71 investment. So I think that I'm going to keep doing what I'm doing, and I'm going to sell calls, weekly calls after weekly calls after weekly calls. Now, jumping down here, notice that I'm selling a low strike price. This is a $29 call and I own a $30 call. So that is actually showing a $1 loss in intrinsic value, right? I own the right to buy Twitter at $30, but then I'm giving somebody else the right to buy Twitter from me at $29. That is a $1 loss in intrinsic value, right? So that's an actual risk, but at this time I am justified in taking this risk because I have made $100, right? 47 plus 48, $96, and then I take in this extra little bit of premium for selling the open, this $29. So 96 plus 28 is 124, $124 profit. So worst case scenario, Twitter goes up to $30 and higher, then I would lose this intrinsic value, but I'm making $126. I'd still be up $26. So my risk in this call option is not on the upside. I hope Twitter does go up, and then I will just roll it up like I've explained in other videos. My major risk is on the downside, because let's say Twitter goes down to $25. This $30 call will decrease in value here. And here, actually, if we go to my account, we can see that the call has already decreased in value, but it will decrease more. If Twitter goes down to 25, I mean, we can even look at the delta. That's actually a good idea. Let's look at the delta on this $30 call on Twitter for January of 2020. Okay, so the way we do that is we go to option chain, and then we go to wrong box, we go to Greeks. It's an option Greek, and then we click on the view chain, and then we click on the date of 2021. That's too far. Let's go 2020, and now we go on the calls. It's on the calls, hit calculate, and now we look at delta. Here's delta right there, and the delta is 0.6. So that means every dollar that Twitter goes down, this call option will decrease $60. Okay, so now back to my little transactions here. So if Twitter goes down to $25, Twitter's at 28, 60 times 3, that's almost $200 that this call would go down. So right now this call is worth the bid is 605, the ask is 630, minus $200, it'd be worth about $450. So big whoopty snot, right? I'd make $34, $35, but then I'm losing. This is why I don't like selling covered calls. Covered calls, in my opinion, can be a very risky strategy, but I have risk management strategies that I use and I have been using, and that's the reason like I am selling this lower strike. Now if I were to sell another $30.50 4 days out, well, let's look at the problem with that. Okay, let's click on the stock, go to the option chain, and let's look at the $30.50. So it's not even on the option chain. I have to click out of the money just so it'll show up. So if we look at the $30.50, there it is right there, and you get a whopping $6. Okay, so obviously it wouldn't make any sense for me to sell a $30.50 call for $6. I mean, commission on TD Ameritrade is $6.95. So I make $6, but then I spend $6.95 on the freaking commission. So not the right thing to do to sell 30. So that's why I sell the lower calls. Right now on the lower calls, I took in $28, and then Twitter went up a little bit. Okay, and I showed you that there's no risk on the upside because I've taken in $126 in premium. So if I do lose that dollar intrinsic value, then I still am up $28. Okay, now last point here before I put an end to this lovely video is, let's say I'm only making $28.29 a month. You saw how much money I could make if I'm making $50 a month, but let's say I'm only making $20 a month, or I'm sorry, $20 a week. Okay, if I'm making $20 a week, that would be $80 a month on a $777 investment on a call option that expires in 16 months. Okay, so if I'm making $80 a month, in 10 months I will make $800. That pays for my $777 investment. So are you catching on here? Are you getting the idea, at least getting a clue that buying stock options, that buying calls and puts is super safe compared to buying stock. I mean, if I would have bought 100 shares of Twitter and not done anything with it, not done any stock options or whatsoever. I mean, this is on the 10th. Let me show you what happened to Twitter since the 10th. Okay, so last point here. If you look at the chart on the 10th here, here's September the 10th. Twitter was at about $30 and some change. I think it was at $30.20. Okay, that was on the 10th. Okay, so the 10th is right there, and Twitter has since then gone down to where you see it right now, which is $28.60. Okay, so if I would have bought 100 shares of Twitter at $30.20, then I would be down $160. Okay, but I'm not down $160. I'm only down about $90. So it's cut my loss almost in half. And as long as I continue to sell these weekly call options, it's only a matter of time before the leverage catches up and I start to make buku bucks. And that's what I'm talking about, ladies and gentlemen. I hope that I am motivating you, whoever is out there watching my videos, to begin buying and selling options. You see that it doesn't take a lot of money to do it, and you don't need to be a brain surgeon rocket science to figure this stuff out. It just takes a little bit of time to learn the basics, the mechanics of an option. You know, what is a call, what is a put, what is the strike price, what is premium, what is expiration, what is intrinsic value, what is time value, etc., etc. You know, you learn those basic things, and then you can go to town and you can do what I started doing on what I consider to be a very small little bit amount of money. $777, not a lot of money here. $2,365, not a lot of money here that I'm playing with. Okay, if you think this is a lot of money, then what you need to do is you probably need to stop watching my videos and start watching Dave Ramsey videos. Okay, he talks a lot about saving money and staying out of debt and all those very, very basic things. If you think this is a lot of money, but if you do save money like I do, then no, this is not a lot of money. Okay, it's very easy to get this much money in just a few months. If you're saving a few $100s a month, you can very easily get started buying and selling options, and just, you know, buy a call for $700 or $600 or $500, and you can pick any stock you want to play around with. I like Twitter because I like the volatility of Twitter. Volatility is where the money is, and that's the game that I choose to play. So that's it for this video. Thank you for watching. I hope that I am motivating you to get into this and jump into this game. So until next time, have a good day, and I will see you in the next video.